Hello and welcome to the Friday market update. Well, mortgage rates are moving closer to some of the lowest levels we've seen in the past few years. And a big reason for that is what we're seeing in the economic data right now. So, according to Mortgage News Daily, rates settled in at 6.04%. We're getting close to that 5% handle for a prime conventional borrower. FHA and VA rates are now approaching 5.5%. They're getting better. Let your clients know, let your buyers know what's going on out there. But here's the key: the headlines look one way and the underlying trend looks differently. So let's break it down. So, the jobs report, the headline versus reality. We just got the latest BLS jobs report, Bureau of Labor Statistics, and the headline showed about 130,000 jobs added and the unemployment rate going down to 4.3%. But wait, is that what's really going on? So on the surface, that sounds like a really good report and a stable economy. But when you dig deeper, the story changes. When the BLS reconciles their monthly survey with the quarterly census of employment and wages, it's called the QCEW, which is based on actual payroll tax records. Job growth was overstated by 862,000 jobs over the past years. The BLS monthly report has been terrible. And when you look at the full year revision, job growth for 2025 dropped from about 584,000 jobs after they initially reported them down to around 181,000 jobs. This is a massive revision, and this is what Wall Street trades on. And why does this matter? The monthly BLS jobs report is based on a smaller survey sample. It's what Wall Street relies upon to trade. They look at the BLS report, and if the job market is strong, it can create wage inflation, which is not good for interest rates, including mortgage rates. The QCEW, on the other hand, reconciles the monthly BLS reports on a quarterly basis. It is based on actual payroll data from millions of employers. So what we're seeing is the initial BLS data can look strong, but the final QCEW data is showing a much slower labor market. And this has been a consistent pattern: big revisions, overstated job growth, conflicting signals. And finally, it appears Wall Street has woken up to the fact that they can't really rely on the monthly BLS jobs data. Normally, when a strong job report comes out, like it did today with much stronger job growth than expected, Wall Street reacts negatively. Today, Wall Street pretty much shrugged off the data, looking at all the other data points showing a slowing job market. And finally, it appears they are waking up to reality. The BLS needs to seriously consider changing methodologies from the old one that was created decades ago. They need to get with the times here. And on top of this, inflation is moving lower, which is also good for mortgage rates. We got another report actually this morning, and the direction is clear. Inflation is cooling down. It went from the headline went from 2.7 to 2.4%. The core went from 2.6% to 2.5%. And a lot of what's still showing up in the data is tied to the housing market, which is a lagging indicator. Rents have been coming down over the past year. Home appreciation has dropped, and it's finally showing up in the inflation numbers. So even though inflation is already improving, there's a strong case that it's going to continue to move lower over the next couple of months, just the way inflation is calculated, where 1 month rolls off and a new month rolls in. And last year we had a couple of high inflation figures, so those should be rolling off next month as well, and we're going to see lower inflation. So that's exactly what the mortgage market wants to see. They want to see a stable economy, and they want to see lower inflation. So mortgage rates follow the bond market, and mortgage bonds are focused on two things: inflation and the strength of the economy. And right now, both are pointing in the right direction for mortgage rates to go down. Slower job growth, lower inflation, and it seems like it's about to get steady. So that's why mortgage rates have been drifting down. And according to Mortgage News Daily, we're now getting close to some of the better levels we've seen over the past few years. Finally, there's another big shift helping mortgage rates. There's what's called the spread between the 10-year Treasury and mortgage rates, and that spread is improving. The spread between the mortgage rates and the 10-year Treasury has historically been around 1.5 to 2%. So that means that if the bond market, the 10-year Treasury was at 4%, and we added 1.5% to that, then the rates, mortgage rates would be around 5.5%. But over the past couple of years, it had widened to over 2.5%. And at one point, it was over 3%. So that extra spread is part of what has kept mortgage rates elevated. Now we're starting to see that spread compress back toward normal levels. And as of today, that spread is almost exactly at 2%. As the mortgage rates drop further, we could see this spread get even lower. Why is that spread getting a little bit smaller? Because mortgage companies start to believe that the new mortgages that are being issued right now will be held longer. The loans are less likely to be refinanced, fewer prepayment penalties, all that stuff that goes on. And that's going to see the mortgage rates lower. Mortgage companies make more money when they hold on to the mortgages, and that matters. So because of, even if the 10-year Treasury stays flat, mortgage rates can still improve as that spread normalizes. Mortgage rates are starting to look like longer term stable investments again, and that increased demand is helping bring that spread down, and that is directly helping our mortgage rates improve right now. So looking ahead, most forecasts are calling for more home sales in 2026 than in 2025. Affordability is improving. We're down about 1% from a year ago. Inventory has been increasing over the past year. Buyers are starting to come back into the market. I talk about it all the time. 40-year-old is the median age of a first-time home buyer. Do they want a home? They want to get into the market. Now we're starting to see some factors that could help them get in. That combination should lead to more activity. And the question becomes, will seller concessions last? This is a big one. So over the past year, buyers have had access to the seller paid closing costs. They have seen rate buy downs. They've negotiated concessions and what we have called for the last year, free money from the seller to help them. It's kind of like a down payment assistance program, but it's closing cost assistance program. But that only exists in a slower market. So if sales do start to pick up because of the lower mortgage rates, these concessions are likely going to start disappearing. I'm starting to see less seller concessions, lower seller concessions, and the sellers only need to give concessions when they have to. So there is opportunity right now for the buyers. This is where you can really help your clients. Over the past couple of years, they've dealt with the higher rates, the higher payments, and rising costs. But right now, there is still a window. I don't know how long that window will be open, but they can still negotiate concessions, buy down their interest rate, get into a home right now, and as rates improve, they could potentially even refinance if the rates drop lower and lower that payment as well. So that strategy certainly has helped those people that bought a year ago as the rates are coming down and we're starting to refinance many people and saving them $200, $300, $400 a month. So here's the bottom line. The headlines may look strong, but the underlying data is telling us a different story. The labor market is a little bit softer, inflation is coming down, and mortgage rates are moving in the right direction. So as we move through 2026, we should see more activity in the housing market and more opportunity. So if you want to stay ahead of what's happening with rates and how to position your clients in this market, join us for the Friday playbook every Friday morning at 8:30. Grab a cup of coffee and see what's happened to the mortgage rates and the real estate market for the past week. The audience is growing. Invite your friends. It's quick, gets you ready for your weekend warrior buyers and sellers. We keep it simple, we keep it relevant, and we give you strategies that you can use right now. So hope you have a wonderful weekend. I'm here in Coronado celebrating my son's 6th birthday today, Friday the 13th. Hope you have a great weekend. We will. We'll see you next Friday. Gaylord out.